6, 5, 4, 3, 2, 1.
Hello, how are you doing? Welcome along to FTUK's Non Farm Payroll live stream for the jobs numbers out of April in the United States. I think it's going to be an interesting one today. Hope you are doing well wherever you are. The numbers will be hitting the wires in just under 14 minutes time, or just under 15 minutes time. Good morning to you in the United States if you are waking up. Good evening to you in Asia, and good afternoon to you in Europe if you are joining us. I am super happy today for two reasons. Number one, the weather is blissfully warm and sunny, and of course in typical British fashion, you get the t-shirts on, barbecues in the garden. You got to make the most of it here because it'll be raining by Sunday. But second is I've got my big computer back, so the Ferrari is in the corner full of firepower, so we can do the stream properly with all the bells and the whistles and the bits and the bobs and then the music and stuff. And we're going to need it because today I think the non-farm payrolls itself is going to be quite a complicated one. So without further ado, let's jump in and let's just see what we have got facing us today. We are looking for 130,000 new jobs out of the United States for the month of April. That is a move down from the previous reading, 228,000. The unemployment rate as well, that is expected to stay 4.2. If you remember last time out, that was 4.1. So we did have a slight step up in the unemployment rate. Average hourly earnings, that is expected to go up very slightly. 3.9 is the consensus on the year-on-year rate, but flat on the month-on-month reading, 0.3%. It's going to be difficult to really sort of dissect this one today. It's very much a mixed bag, and I'm going to go into the reasons why that is, because we had a lot of bad data throughout the course of the week, which we're essentially looking for non-farm payrolls to actually bookend as well. But there's also been some positive news on the environment as well, in terms of what's happening in the geopolitical landscape. So we'll get into it into all detail. But first, let's start with the actual bad data. Not great, really. Jolts itself, that came in lower, 7.192 million from the previous 7.48 million. Job quits, they went up slightly as well. Pressure, more recessionary sort of like pressure coming into the economy now from the March reading, maybe potentially, but it was exactly the same for ADP as well. And if you remember ADP, that really led and was a real barometer for last month's non-farm payrolls. So it's going to be interesting to see if it follows suit again this month. But look at that ADP number. This is private sector payrolls, 62,000 from the previous 147. That is not particularly good. So you can see this jobs data now is feeling it's quite heavy and it's hanging on the data today. So this is where we're going to potentially get the volatility from. Now, that's not the only data that we had this week. We also had a really disappointing GDP reading. This was the advanced quarter one reading for 2025. Negative 0.3. I mean, that's not particularly great. And that means that the emphasis today is all going to be about growth in the economy with the shift and what has been happening politically and from a trade point of view. Everything is about growth and the way that those jobs feed into growth. That is what we are looking for. We're going to go through it in some detail and look at some key markets, but also as well bear in mind this is the final bit of data that was not really what potentially we would be looking for, and this is going to put pressure on the Federal Reserve. It's the PCE, the inflation reading, which the Federal Reserve really hangs its hat on. That came in lower as well, completely flat, 0.0, just zero. From the previous 0.5%. That's the month-on-month reading for PCE. That is going to put pressure on the Federal Reserve. Now, most people are expecting a cut because obviously the Federal Reserve is next Wednesday. Most people are expecting the Fed to cut, and I think they probably will. But really, we can use today's job data to confirm that, and you can do that by having a look at the Fed Watch tool. If you look at it over here, you can find this on the CME website. It's a very super cool tool to keep a track of, and you see the changes in futures and options when it comes to interest rate products, and that is essentially giving us an idea of what the market thinks is going to be the interest rate at any particular point in time. So this column here on the right hand side, that's showing 93.2%, and what that means is it means that 93.2% of the people invested in those sort of futures and options for that point next week think that the interest rate is going to be between 4.25 and 4.5. So we've got interest rates at 4.5. So basically that's saying that bar is showing most people think that we're going to get a cut next Wednesday. That's the take home. That's the important bit. Now, I would suggest that if we did get a push down, if we got a positive jobs number today, that would essentially push that number up. So it's going to be interesting to see what happens to that number after the actual jobs gets printed. So, what have we got to really consider? Well, like I said right at the very, very start, I actually think it's going to be quite a complicated one to figure out today. And, you would be forgiven for wanting to just like step aside when things get a little bit complicated, because I understand it. I wouldn't want to be all over this one. So, let's go through the markets and the details of why it's complicated in a second. But let's just start for anyone that's new, that's never been through it before. Let's just go through a quick primer so everybody knows what we've got to be dealing with. We do this very, very frequently. It's a government statistic that is printed on the first Friday of every single month. Everybody should know this now. Of course, it doesn't include people in the farming industry, private households, non-for-profit organizations, anybody in the military who is active or self-employed. They are not included. Everybody else, they are counted as part of this statistic. And it's so important because 80% of those people then drive into the actual GDP reading of the United States. And that's where we get our deeper understanding of GDP from. It helps us understand the health of the economy, and then the market takes that information, prices it in, and the markets move accordingly, which is why we get volatility around non-farm payrolls. And a quick tip for you, the most valuable bit of non-farm payrolls is the Tuesday, Wednesday after. That is by far the most strongest place if you're looking to pick up a trade. You'll always find let the market absorb the data, stay away from the volatility, but it's always useful in the coming week as you start to figure out which direction the market is going to go. 8.5 minutes to go. Now, how do we actually sort of like think about the way that non-farm payrolls filters into the economy? Well, essentially, if you are creating a lot of jobs, what you're doing is you're supporting the economy and you're supporting growth. That should be, in theory, positive for risk assets. A very simple picture that we've got at the moment. That would essentially lead to an upward pressure on inflation. That was where we would say it's potentially it's hawkish if we're creating jobs, and therefore use the need to hold interest rates high or even increase them, or even look at not cutting them. That's also the lean on that. So that's what we would get if we were looking for higher job prints from here. If it's the opposite case, which is essentially what the data has been telling us throughout the course of the week, we'd be looking for a lower jobs print, and that would mean that you are not creating as many jobs. Maybe you're not creating enough conditions to create the kinds of jobs, and that's negative for growth. You see, this all connects into GDP. That would be negative for risk assets, some of the more speculative things out there, obviously your indices and equity markets. So, low numbers, lower stock price, that kind of thing. Pressure on the dollar as well, less inflationary. We would describe that as being dovish, as in, we've got, we would now need to lower interest rates to basically stimulate growth, bring those interest rates down, make borrowing cheaper for businesses so that they can juice the economy. That's how it works. This is not new news. This is all pretty standard stuff. And the narrative is quite clean at the moment. Now, you always get a fundamental structure around it, and this is where it starts to get a little bit more complicated, because we've now got positive big news stories. We've got the US and China now sitting down to actually start to think about what to do with tariffs. Same with the Europeans and the US as well. So in typical Trump fashion, you've got this very, very aggressive narrative which spikes volatility, spikes the market, and then from there, the actual end result ends up being a lot more a much softer end result after that. So, and that's a very typical way that Trump tends to do business, tends to lead his policy. That is what is now, that positive news stories now is making it more complicated. And when we get to the charts, you'll see it, because where the Liberation Day happened on the 2nd of April, we've now retraced the majority of that now in equity markets. That makes it far more complicated, yeah? So the bad data on the one hand this week should be very, very straightforward if we get a low print, but I suspect that this is going to be where the market will end up focusing on, because you've also got a mineral deal now that's all been done between the US and Ukraine. That's stability. It's back end, it's sort of putting a back end bit around the actual conflict in Ukraine and Russia. It's gone on a long time. That's going to be positive for the markets as well. So you can see it is quite complicated when you start to pick over it. Now, for today, I suspect that we will, I would be looking for a low print. I would be looking for the non-farm payrolls to fall in line with JOLTS and also ADP, and that would make things from a data point of view relatively simple to understand. But because of the news stories, that should essentially, what it should do, it should tank both the stock market, which would be is a good spot right now, and then also as well, that should then start to weaken the dollar, just lifting us up a little bit, and that euro dollar rate should be essentially holding quite strong. But I don't think that's going to happen, because I think if you do get a low print, I think the bigger news stories will end up creating everything as a buying opportunity. So any downward pressure you get in the stock markets today ends up being scooped up by the bigger boys later in the week, sometime next week. I think that's my read on it for today. We will see, and it obviously depends on the actual number itself. So this is the way that I'm thinking about it. I'll show you the charts in a second of what I think, but I think it's a better play on FX. I think it's cleaner technically than it is on indices for some very, very core reasons. Let's just bring up the US equity markets first. We'll just stick to the S&P, keep it nice and simple. We've got 4 minutes now before we actually get the data. You can see it over here. There. So that's where the Liberation Day was there. Look, we've now retraced pretty much 95% of the entire move. And what that means is it means that if we are going to get a negative print and we are going to push to the downside, then essentially, because of the big news stories, we're starting to look for key support around here. And it ends up just being a buying opportunity. But that then means you have to get past the Liberation Day high. And you have to do that relatively quickly. If not, this whole sort of like story is going to fall apart very, very quickly. And I'm not sure. So therefore, I don't like it on indices. I think there'll be scalping trades there, but I don't like it. I think it's a much more complicated picture. When you look at the when you look at the FX markets instead, I think it's much cleaner because of the way that it's painted out technically. So there you can see it. If we're looking for a low number now, you'd be looking for this to sort of like test this neckline area. And this is a bit of analysis that we did in one of the emails that we sent out a week or so ago. And you can see we have got technically a very, very nice head and shoulders pattern that has formed. And so far, it looks like it is working out. So if we're looking for a low NFP print, well, obviously we're around that with the 130. Anything lower than that, we're looking for pressure on the stock market, pressure on the dollar. That's going to lift euro dollar up, and that could give us the test of the neckline that we're looking for. This is the daily time frame that you can see in front of you here. And that test there would come in around about the late 113s, maybe early 114s, and it would still be valid as a head and shoulder setup. And that's really cool. Now you get the exact opposite on the dollar index. So if you look at the dollar index here, you can see we've actually got an inverse head and shoulders. And bear in mind that's a major trend reversal swing point there, and that's where head and shoulders as a chart pan sits at its strongest level on timeframes like the daily at major trend reversal points. That's very, very important to understand. Now if you put a reverse head and shoulders on this, and we just sort of went from that swing high, you'll see what I mean there. There's your left, in fact let me just paint it in roughly for you so you can see it. You got your left shoulder there, your head, and then that gives you your right shoulder there. So again, it's definitely, oops, sorry. Oh, I made a mess of that, haven't I? Let me just bring that in line there. In fact, I'll tell you what, let me just put my magnet on. Better just keep an eye on the clock as well. There, just bring that in there. So you get that head there. Whoops. There. So essentially, because it's the dollar index, you've got the exact opposite. So it just shows you how strong as a chart pan that's feeding into the dollar rather than just the euro, as it were. Yeah. So you've got that. It's very, very strong. A test of that and then rejection would give us a very good reason to use this kind of simple technical analysis, and that's the reason why I prefer it on the FX pairs today rather than on the indices. So we will see what the actual jobs number is going to be. We've not got long now, so it is probably time to quieten down. We remember we are looking for 130,000 new jobs. Let me go back to I want to watch it on the euro dollar actually, and then we'll go. I'm going to watch it on a 4-hour time frame because I really like I would be looking for this head and shoulders to now work out. And also bear in mind that if you are playing a big picture chart pattern like that, it doesn't stop you from working intraday. It doesn't stop you on working on smaller time frames. In fact, it actually helps you. Yeah. So always bear that in mind. So we will see. I'm looking for a lower print now to confirm the data, give us an uplift, and then look for that for a sense of rejection of that neckline if we're going to get it. Right, we've got 20 seconds to go. Sorry, 25 seconds to go. We're expecting 130k. 13 seconds to go. Stand by. $177. Better than expected. There you can see that dollar strength coming in straight away. You see that? 177. The prior was revised down to 185. That's interesting as well. That could add extra complication. Nothing on the unemployment as well. So for yeah, so just getting some pressure now on that euro dollar rate. Well, I was hoping for maybe a flush high, which we could still get for sure throughout the course of the US session, so it's not quite over yet. And bear in mind that's on a 4-hour time frame. Just take it down to a 15. Let's just see the actual volatility itself. Yeah, so if we are going to get that move up so we get a cleaner neckline on this one, then I would say that you're going to need to hold these areas or flush lower to then end the week a little bit higher than when we currently are. Otherwise, this is it could be very, very bearish. And, you know, bear in mind with head and shoulders, they are a beautiful pattern to trade when you really get into it and you understand what you're doing. But the measured move on this one and the way you measure that on head and shoulders, the height of the pan itself down to the bottom of the neckline. If you just bring that in there, you'll see from the break, it is really nice. It takes us right neatly back down to this mid 110.50 area. So I like it a lot, yeah. And it's the same sort of like on the it'll be the same on the other majors as well. It's that dollar that is giving us that chart pattern. So yeah, interesting. Let's see how that plays out for the course of the rest of the session. And yeah, like I said before, always bear in mind that non-farm payrolls, let the market absorb it, and then it's always very, very useful later on next week, Tuesday, maybe Wednesday. You'd be surprised how often the market absorb it and then you get the trade that you want just by understanding what is going on. Super, super important. Okay, that is it. So yeah, finally, before we actually sign off for the day, then it's worth just mentioning that we have got a fantastic deal because we are celebrating non-farm payrolls, as everybody should celebrate non-farm payrolls. We've got a great offer on the website over the course of the weekend. Nice and straightforward. All of the things that people like in their challenge accounts and their instant funding. It's NFP 30, a massive 30% discount on all of the accounts. And if you decide that you want to go down the instant funding route, you get an extra 2% drawdown. That's very, very popular. It's only on level 1, but I'm telling you, it really helps. It really does give everybody a bit of a boost. So an extra 2% drawdown on level 1 for the instant funding. All of the 1 steps and the 2 steps, you automatically get weekly payouts thrown in there for free without any extra cost involved. So yeah, great offer for the weekend. Other than that, that is it. That is it. We are done again for another non-farm payrolls. Yeah, definitely an interesting one for sure. I think that's going to give us, paint us a really, really cool picture for next Wednesday's FOMC interest rate announcement. As they say, sell in May and go away, but I'm not quite sure on this one. Things look like they are just starting to get interesting. Thank you very much for joining us, and we will see you all next Friday.